Two stocks that can double in 4 years. I normally talk about stocks that can double every 5 years or 15% a year, but this one is a 20% annual return or a double in less than 4 years. You don't find them very often. I'm going to talk about them. The first one is a stock that I talked about recently, and I'm personally considering it for my portfolio. I've been researching the company a little bit more, and it's very, very interesting. The second one is a stock that I told you guys I'm going to buy the dip on the stock, and I did buy the dip. So I'm going to talk about it a little bit, nothing too crazy. And I really hope you enjoy it as always. Now, the first stock is Meli, which is Mercado Libre. The stock is down 18% on the month. And this is pretty much common with Meli. I mean, if you look at the chart, it goes up and it has those sharp drawdowns on pretty much no news. Then it bounces and it starts going up. Then it goes down on no news. This is a similar pattern, and we're likely near the end of this pattern with Meli. But what's really interesting about the stock is that it's pretty much only up 4% since 2021. But since 2021, revenues are up 617%. Earnings per share is up 2,532%. The company was unprofitable back then. The PE went from 743 times to 40 times, and the stock price, and it's actually less than 40 times, the stock price is only up 4%. So to me, Meli is looking very, very interesting over here. But Meli is mainly a leader in e-commerce, and the country is highlighted here in the picture. They have over 100 million unique active buyers on the platform. They're one of the biggest, and this is a rapidly growing region, and Meli is benefiting a lot from that. They sold over 1.8 billion items, with 75% of those items being delivered within 48 hours. This is a record for Meli and for the region over there in general. And this is what gives Meli a moat or a competitive advantage. And I would call it the physical moat, because the company has a lot of physical assets. They have a lot of planes, they have the infrastructure, they pretty much own it all. They don't just sign it up to a third party to deliver everything. It's more capital intensive, but that gives them a moat. It gives them a lot of control over the speed of the delivery and everything, kind of like, Amazon in the United States. And it gives them a competitive advantage over other players that are trying to enter the space in Brazil and Argentina and in other places where Meli has a competitive advantage, not just due to brand recognition and maybe first mover advantage, but it's also due to the physical moat, which gives Meli a competitive advantage in terms of the speed of delivery. And that's pretty amazing. But the company doesn't only have a leadership in e-commerce, they also have a leadership in financial services. The payment volume is growing 40% CAGR. This is absolutely insane. Monthly active users, 61 million. I believe now it's 64 million, if I'm not mistaken, but 61 million as of 2024. Now, if we look at their competition in key areas, one of them is in Argentina in the fintech space. You look at Mercado Pago on the dark blue, it has a leadership, it's number one, it's not even close. And other competitors, as you could see in this chart, they're struggling to even match Meli or Mercado Pago in this case for fintech. Looking at Mexico, Mexico is not the best area for Meli, but it's gaining rapid momentum. As you could see here, it's growing and growing and growing. It's not as high as BBVA and maybe other players, but it's the second in terms of market share, and it's rapidly taking market share, and they could potentially overtake BBVA over the next few years. They have a lot of momentum. They also have a lot of momentum in Brazil. They're not number one. They're also number three, almost number two. And you can see the orange line, how they're rapidly growing in this area, and they're gaining a lot of momentum. Maybe they will never be number one, but again, I love the momentum and I love the steady growth in the business, which is pretty amazing. Now, the only bad part about the financial services business is they're holding all those loans on the balance sheet. So I would have preferred a business model like what SoFi is doing, where third-party lenders are holding the loans and SoFi just collects fees for originating them. But Meli is doing everything themselves and they're holding the loans on the balance sheet. And we could look at the past dues over 50 to 90 days. It's declined to 6.7%, but over 90 days past due is like 18.5%. It's not too low. And, it's really not the best business model ever. I don't like it, but this is part of the business, and Melly is controlling those losses, and they've been improving over time. Now, in terms of the competition, which is the biggest reason why the stock has been declining, mainly due to Amazon expanding more in Brazil, which is a stock that I own, and I like the company very much. But if you really look at the competitors in Brazil, the first one is Shopee. It's gaining massive momentum, massive market share. The second one is Mercado. Mercado is also gaining massive market share and is growing alongside Shopee. The third one is Amazon. Amazon's market share has pretty much been flat since July of 2023. It has some spikes on Prime Day and then it goes back down. Then it has some spikes and it goes back down. It's not having steady momentum like other. Even Temu is having more steady momentum than Amazon. So the concern is that Amazon is investing in this area more, and they're gonna potentially disrupt the Meli in Brazil. And this is very, very possible. But so far, I have not seen it. Amazon has been there for a while. And since 2023, the market share has been flat. This is another chart that shows you the total app traffic on monthly active users. Mercado is by far number one and is growing rapidly. Amazon is number two. Temu is even declining recently. And Shein and AliExpress are declining. And again, Mercado is still number one, and they have a lot of momentum. So I believe the Amazon competition thing is overblown. It's real, of course, and it's a concern, but it has been there for a while, and nothing has been done to disrupt Meli. And I'm not saying what's going to happen now that's all of a sudden is going to change the trajectory that I'm showing you in those charts, which is why I'm liking it very much. Now, in terms of the latest quarter, it was stunning. I mean, you look at those numbers and you believe like this is some kind of a micro cap. Because what kind of a multi-billion-dollar company is still growing revenues 30, or you should say GMV 37%, is growing items sold 31%, the credit portfolio is growing 91%, net income margin is expanding, it's around 7.7, TPV is growing 61%. This is like a small cap. I would say this is a small cap company because the gross numbers are just impossible. They're insane. They're just too hard to believe. And the growth is very well diversified. Most of it is, of course, coming from Brazil. This is their largest area. Then they have Argentina, the second largest one. A lot of growth has been happening over there, as you can see here. Then you have Mexico. Mexico is also growing. And you have other areas where the company is expanding into. And by the way, I'm using Fiscal.AI to come up with this chart and all the charts I'm showing you. So if you want to try it out, it's give you 2 weeks of free access if you use my link into the description. But over the last few years, Mercado traded as high as 70 PE, so around 68, 70 times earnings, now trading at 37 times earnings. The company has had a massive, massive multiple contraction. They're still growing a lot, but they're trading at 37 times earnings. Now, I believe some of it is actually justified because the company used to grow earnings per share 100%. Now they're growing 50%. 50% is still madness. It's still crazy. But it's not 100%, and it warrants a multiple contraction. And I'm sure most of you are not expecting Meli to grow 100% forever, and I'm sure most of you are not expecting Meli to grow 50% forever. So over time, the growth is going to decline. Same thing with revenue growth. The company used to grow 77% in revenues. It dropped to 52, 40, 37, 35 this year. Next year is expected to be 26 and potentially 21% growth, which is why in my model, I have to use a multiple contraction from the current multiple of 37 times. And this is the estimates that I put up. Meli is expected to grow 50% this year and 33% next year on the year after. So this is what I did. I put the current number, I put in 50%, 33%, then a gradual decline, 25%, 25%, 20%. I think they can maintain on an earnings per share basis at least 20, 25% on those years because their net income margin is only 7.7%. And over the long term, they have the potential to expand their net income margin potentially to 15, 16%. So it's not only a revenue growth story, but it's also a margin expansion story over time, which should drive very high earnings per share growth, at least for the next 5 years. But because, again, the growth is declining, the current PE is around 37 times after the huge contraction, and I'm still using 30 PE. So I'm trying to be a little bit more conservative with the PE. So I'm using the 30 PE. In total, if I use all those numbers, I'm getting 144% on the upside, or $5,000 per share. The current price is $2,000, which would be a 19.6% annual return on Melly over the next 5 years. Back in my previous analysis 2 weeks ago, it was a 17% annual return. Now it's almost a 20% annual return, or a double every 4 years, with an amazing, you could say, a wide moat company like Melly in a high growth region. So to me, it's looking interesting, and I'm still researching it, and maybe I could potentially own the stock, but I'm still looking into it. Now, the second one, which is a funny pick, which is a competitor to Melly, is Amazon. And this is the ones that I own, and it's been a disappointment. It's down 3% on the year. Every single stock is up. Even, I believe, Coke is up, Coca-Cola is up, Pepsi is up, I think, and Amazon's down 3%. So it's been a little bit of a disappointment. But this is the times where you have to look at what Mr. Market is doing, and you have to look at what the company is doing. And if the company is getting better, but the stock's going down and it's looking undervalued, then to me this is an opportunity to be buying the dip. And that's why I bought a little bit of the dip on Amazon, and I started buying it at 175, and I've been, averaging up since then. But for Amazon, the biggest concern is Amazon Web Services. And this is a concern, by the way. You can see the growth. It's not bad at all, but it's still a concern because it's underperforming Microsoft Azure and Google Cloud, especially on a growth basis, because the growth, again, was 35%. It declined, then it reaccelerated, and now it's been flat. And a lot of people are concerned that it could potentially decline again. But if you look at the story of Microsoft Azure, most of the growth has been happening because of OpenAI. They own OpenAI. OpenAI is using Microsoft Azure for the cloud capabilities, and this is driving most of the recent growth in Microsoft Azure is mainly coming from OpenAI. Now, Amazon does not have OpenAI, but they have something else called Anthropic. Anthropic is a leader in a business kind of side of AI, and I showed you some charts in my previous video, but they are a leader in the space, and they're leading OpenAI in the space. But if you look at Anthropic's annual run rate, it's 5x in 7 months. So the company is doing really well. They're growing rapidly, and things have been headed into the right direction. But if Anthropic is growing so fast, then why is AWS not growing as fast? Because Anthropic is using AWS for the cloud capabilities, just like Microsoft, or just like OpenAI is using Microsoft Azure. And the reason for that is there's a data center that's being built for Anthropic by Amazon Web Services, and it's going to host most of the growth that's going to be coming from Anthropic. And this is a good article on a website called Semi-Analysis Core Research. I would encourage you to look into it. And it's mainly showing that by September, things should be completed. And as it comes online, Amazon Web Services is expected to reaccelerate from 17%, 18.5%, 21, 23, 25, and it's going to drive massive growth, just like the growth that's coming up from Microsoft Azure because of OpenAI. So this is a big catalyst. The market is not seeing that. The stock is going down. And to me, again, this is an opportunity. It's looking interesting. But Amazon is much more than just AWS. The advertising business is underrated. It's growing 33% CAGR. It's massive, massive growth. And again, I believe it's underrated. I think the robotics business of Amazon is underrated. If you look at, just a short video, for example, this is an insane technology, and this is as of 2024. It's not as of 2025. So the efficiencies that could come from that, the margin expansion, and potentially licensing this technology to other players or to other places, the potential from that is insane, and it's really not priced in the stock at all. And also the potential of something a little bit crazier, like Amazon is testing a humanoid robot that could deliver packages. So in the future, maybe in 10 or 15 years, we could have maybe an autonomous van that's some autonomous robot is driving it, or a humanoid, and then they go deliver packages to people's doors. Now imagine the efficiencies that could come from that. And this is over the very long term, but they're testing it on 20,000 electric Rivian vans. So you could see the potential over here over the long term. The robotics story is really not priced in the company. Even though robotics and AWS together have improved efficiencies for Amazon to 50% gross margin. So this is one reason why gross margins have improved, is also because of robotics. And I think it's not priced in. And I like that it's not priced in, because that's why it's offering an opportunity. Now, if I'm looking at all of that, I'm only paying 14 times price to operating cash flow. 14 times for all of that for a company like Amazon is really cheap, especially in this market, and especially considering that Amazon's operating cash flow is expected to keep growing around 21%, 20%, which I believe the stock will likely return a similar return to the operating cash flow growth of around 20 to 21% annual return. Now, I always get some pushback and says, why don't you use free cash flow? Because if you look at the capex on Amazon, yes, they're getting 121 billion in operating cash flow, but they're spending 107 billion on capital expenditures. And this is 100% true, but most of it is not really maintenance capex. Most of it is really in growth capex, because Amazon is trying to grow. They're trying to solidify the modes. They keep investing in real estate. They invest in many different things. So this is a capex that they can really pull back any times. Just like the research and development, they can kind of pull it back any time and show massive profitability. This is why I'm using cash from operations and not free cash flow, because it's hard to predict the level of capex that Amazon decides to put up. They could decide that maybe this is peak capex and it's going to be stabilizing or coming down over the next 2 years. And if capex stays the same, well, operating cash flow expands to 200 billion. The kind of profitability here could be absolutely insane. So again, I love Amazon. I think it's presenting one of the best opportunities in the market. I don't know if the stock's going to keep going down. It looks weak to me. Maybe it will keep going down. But to me, this is an opportunity to average up a little bit more and own one of the best big seven with a robotic story, advertising, AWS, so many different things. And again, all in one stock. I like it. And I like Melly very much, and I'm considering it. But I share everything I do in my own group. And this is the link if you're interested. Thank you very much for watching. Not financial advice. Hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.